Hey everyone, Alex here with Morgan. The bell has rung, the tape is in. Let's break down what actually happened today versus what we thought this morning.
It really was a day that felt like, I don't know, a whole month crammed into just 6.5 hours. It was wild.
It really, really was. And, if you just glanced at the closing numbers on your screen, if you were just sort of walking out of the office to get a jump on the long weekend, you'd be forgiven for thinking today was a complete non-event.
Right. A total sleeper.
Exactly. We're calling this the chop session.
Which is probably the most deceptive label we could possibly give it, but honestly, it's the only one that really fits those headline numbers.
Oh, extremely deceptive. Because the headline is that the market went nowhere, but it did so very, very loudly. Let's just run through the stats real quick. The S&P futures, the ES, flat.
Flat.
I mean, literally down 0.00%. It's almost comical. Then you look at the NASDAQ futures, the NQ.
The same story.
Plus 0%. You can't make this stuff up. It is the textbook definition of a stalemate.
But that stillness, that calm on the surface, it's hiding a pretty significant amount of violence right underneath. We call it a chop session because the market spent the entire day trying to price in all this conflicting data and just completely failing to pick a lane.
And the internals were aggressive.
So aggressive. And that's where you see it. You just look at the VIX. It's sitting at 21. That is not a sleeping market by any stretch of the imagination.
Exactly. Let's just pause on that VIX number for a second because I think it tells a huge part of the story today. A VIX at 21 is a market that is wide awake and arguably drinking way too much coffee.
Jittery?
Very jittery. In a typical flat day, especially a Friday before a 3-day weekend like President's Day, you'd expect the VIX to just get crushed.
Yeah.
It would bleed down to maybe 14 or 15.
For sure. The vol sellers would be out in force, just collecting that premium before heading to the Hamptons.
But not today. A VIX at 21, it basically screams alert. It's telling you that traders are paying a significant premium for insurance because they just do not trust this calm.
And you really have to remember the context of why they don't trust it. This morning, our call, and frankly, the entire street's call, was that this was going to be a macro-driven, rate-sensitive day.
Yeah, we knew it. We knew we had this whole stack of data coming right at us.
A huge stack. GDP, interest rates, inflation. We fully expected the macro data to be driving the bus today.
And it absolutely did drive the bus. But it felt like, two different people were fighting over the steering wheel, and neither one of them had a map.
That's a perfect analogy. We got the macro data, but the data pulled in completely opposite directions. It was just a total tug of war.
You had one print basically saying, hey, growth is fine, and then another one right behind it screaming, inflation is crashing, and then a third one whispering, rates are doing something really weird.
And the result was this equilibrium of confusion, a stalemate.
It's what we call the muddle. When the data is this mixed, the algorithms just cancel each other out.
Yeah.
You have one algo furiously buying the GDP news, and then another one just as furiously selling the rate news.
And the human traders, they just throw their hands up, hedge their books, and go home, especially on a Friday before a holiday weekend. You're not going to stick your neck out in that environment.
Right, and we can't forget that piece. President's Day is Monday. The U.S. markets are closed. So today wasn't just about digesting the data we got. It was about positioning for a 3-day break where, literally anything can happen.
Anything. And we even have a catalyst coming tonight, which is just bizarre.
We'll get to that. But first, let's unpack this muddle a bit more. Because the devil is always in the details, and if we just gloss over it and say, oh, it was mixed data, we miss the real signal for what might happen on Tuesday.
Agreed. We have to start with the big one, the GDP number.
The headline number of the morning, for sure. Q4 GDP growth rate. The expectation was 1.3%, the actual number that printed.
1.3%, right on the nose, in line.
The definition of priced in. But let's dig into that for a second.
We have to, because on paper, this looks like the Goldilocks scenario, doesn't it?
It really does. It wasn't hot enough to force the Fed or, the central bank authorities to get super aggressive and start talking about hikes again, but it also wasn't cold enough to make everyone scream recession right away.
It's holding the line. It's fine.
But that's the surface level take. And here's a problem with an inline print in this specific environment.
Right. Tell me.
In a normal market, an inline GDP print like that, hitting the consensus estimate right on the nose, it usually crushes volatility.
Yeah, it validates the models. It tells the market, hey, you were right. The analysts actually know what they're doing. Volatility should have collapsed on that print.
But it didn't. The VIX is still sitting at 21. So the obvious question is why? Why is the fear gauge staying so high if the biggest economic number of the day is exactly what we all thought it would be?
Because you have to look at the composition of that number. It's all about the quality. Is that 1.3% growth coming from a vibrant, healthy consumer who's out there buying houses and cars and, driving the economy forward? Or is it coming from government spending and inventory builds that are really just masking a pretty significant slowdown underneath?
A low-quality number.
Exactly. The market looked at that 1.3% and didn't see strength. It saw stagnation. It saw an economy that's barely keeping its head above water, even with massive amounts of fiscal stimulus still sloshing around.
So it's not a confident 1.3, it's a nervous 1.3.
A very nervous 1.3. And you can't look at GDP in a vacuum. You absolutely have to look at it alongside the interest rate decision and, I think even more importantly, the inflation rate. Because this is where the narrative really starts to fracture into a million pieces.
Okay, so let's get into that. The interest rate decision. This was, I think, the real surprise of the morning session. The expectation was for a rate of 16%.
Right. 16% was the consensus.
And the actual number came in at 15.5%. That's a miss to the downside.
And in the world of rates, a 50 basis point miss, a half a percentage point divergence from what everyone expected, that is a massive, massive deal. It forces an immediate repricing across credit markets, foreign exchange, everything.
Let's just clarify this for anyone listening who isn't staring at a terminal all day. A lower interest rate usually sounds like good news for stocks, doesn't it? Cheaper money, better valuations for tech companies.
Right.
So why did this cause chop instead of a huge rally?
It all comes down to the reason for that lower rate. It's about the narrative. If the rate is lower because the central bank comes out and says, great job, everyone, inflation is beaten, the economy is strong, here's some cheap money as a reward.
That's a party.
That's a party. Stocks go to the moon. But if the rate is lower because the central bank sees something scary, if they see the plumbing starting to leak in the banking sector, or they see some serious stress in the credit markets that we on the outside can't see yet,
then it's a panic signal.
it's a huge panic signal. You're talking about a defensive cut versus a celebratory cut.
Right.
And the market spent the entire session today trying to figure out which one this was. When you miss by 50 basis points, you literally break the algorithmic models. Bond traders have entire yield curves built on a 16% assumption. Suddenly, the tape prints 15.5.
Everything has to be recalculated.
Everything. Every carry trade, every currency hedge, every discounted cash flow model has to be completely recalculated in milliseconds.
And that explains the violence we saw in the internals. It wasn't just people buying and selling stocks. It was the machines, the algos, recalibrating the fundamental value of money itself in real time.
And that massive recalibration collided head first with the inflation print.
Oh, the inflation print, this
Right.
one. This is the one that really stood out to me. The inflation rate for January, the estimate was 4.9%.
Which was already a step down, from a previous month.
Right, and the actual print was 3.2%.
I mean, that is a massive miss. It's staggering. Usually we're sitting here arguing over 0.1%. It was 4.8 instead of 4.9.
Yeah, this is a 1.7% gap. Inflation cooled significantly faster than literally anyone on the street expected.
And this is where we get to that big question. Why didn't stocks rip higher?
The million-dollar question of the day.
Conventionally, if inflation crashes like that, especially when you also just got a lower interest rate print, equity should have flown. It should have been rocket fuel.
It means purchasing power is back. It means policy can loosen up even more. It should have been a bright green light for risk assets across the board.
But the S&P was flat.
Because the market doesn't trust it. It's as simple as that. When inflation drops that fast, from an expectation of nearly 5% all the way down to 3.2, it starts to look less like disinflation or cooling and more like demand collapse.
The deflationary fear, the bad kind of deflation.
Exactly. If prices are coming down because supply chains are finally working and, technology is making things cheaper, that's fantastic. That's good deflation. That's the soft landing everyone has been dreaming of. But if prices are coming down because consumers have just suddenly stopped buying anything because they've run out of money or they're terrified of losing their jobs, that's bad deflation.
In a recession, that's the hard landing scenario.
So imagine you're a trader sitting at your desk at 10 a.m. Eastern. You see the GDP print saying, hey, we're fine. Then you see the rates print saying, uh-oh, something might be wrong. And then you see the inflation print saying demand just fell off a cliff.
And the result of all that is paralysis. That is exactly why the S&P 500 finished at 0.00%. It wasn't a lack of interest. It was a complete abundance of contradiction.
The market looked at that 3.2% inflation print and thought, wait a minute, is the consumer dead?
It's the difference between gently tapping the brakes to slow down and just slamming headfirst into a brick wall. And the market is now seriously worried we just hit the wall.
And that deep anxiety kept a lid on any enthusiasm. You could see it in the curve steepening, too. The spread between the 10-year and the 2-year yield is moving, and that's telling a story.
I want to pivot to that, to the asset class divergence, because it really tells the story of who believed what today. Different assets were looking at the exact same data and seeing completely different movies playing out.
Let's start with equities. They basically took the wait-and-see approach. SPY up a measly 0.07%, QQQ up 0.21%.
That is effectively a do not disturb sign hanging on the door. Equity investors looked at all this mixed data, they looked at the long weekend coming up, and they just hedged their books and went home.
But then you look over at the crypto screen, and it's a totally different vibe. The risk-on rebels were out in full force today.
They absolutely were. Bitcoin is up over 4%, sitting near $68,900. Ethereum is up over 5.3%, back above $2,050.
So while the stock market was chopping around going nowhere, crypto was bidding aggressively.
This is the fascinating divergence of the day, I think. You have to ask yourself, is crypto the smartest guy in the room right now, or is it just the most reckless?
The classic argument is that crypto is the canary in the coal mine for liquidity, right?
That's the bull case. If you believe crypto is basically a giant liquidity sponge, then a lower interest rate, that 15.5% print, and collapsing inflation, which implies future rate cuts are coming, well, that's rocket fuel.
So crypto doesn't really care about the demand collapse aspect of the inflation number.
Not as much. It cares more about the prospect of money printing. It's sniffing out a liquidity pivot before the equity markets are. It sees that 15.5% rate and the low inflation and thinks, here comes the easy money again.
Okay, that makes sense. But there's another theory.
There is. It's what I call the weekend casino theory.
The weekend casino.
Yeah. Crypto trades 24/7. Equities close at 4 p.m. Eastern on a Friday. So if you're a trader and you're amped up and you want action over the 3-day weekend, you can't buy Apple, you can't short Nvidia.
But you can buy Bitcoin.
You can buy Bitcoin, you can buy Ethereum. Sometimes these high beta assets ignore the macro chop simply because risk appetite needs a home, and the doors to the stock market were locked for the weekend.
That's a really fair point. It's the only game in town until Tuesday morning.
But let's look at the boring stuff, the rates and the bonds, because that's where the smart money usually lives.
Right. We saw the 2-year yield at 3.40% and the 10-year at 4.04%.
The curve is steepening. The spread between the 10-year and the 2-year is widening. And we should probably explain why this matters, because the term steepening sounds very abstract until it actually hits your portfolio.
Yeah, let's do a quick educational moment here. What's the difference between a bear steepener and a bull steepener?
Okay, so the yield curve usually slopes upward. It makes sense, right? Long-term debt should pay you more than short-term debt. When it inverts, like it has been, with short rates higher than long rates, that's historically a bad sign. It's the recession signal we've all been living with. And now it's starting to uninvert. It's getting steeper again. But there are 2 ways that can happen.
Right. A bull steepener is when the short-term rates, like the 2-year, fall faster than the long-term rates. That usually happens when the Fed is about to slash rates to save a struggling economy. It's called bullish for bonds.
That's the cavalry is coming steepener. It's a positive signal in a weird way.
Exactly. But today, we saw some shades of a bear steepener.
Yeah.
And that's when the long-term rates, the 10-year, either rise or just stay stickier than the short end.
Which means the market is demanding more premium, more reward to lend money for a long time. It usually signals that the market is worried that inflation is going to come back in the future, or it's worried about government debt and fiscal discipline.
So which one are we seeing today?
Today feels like a really messy mix, but it's leaning towards the long end repricing. That 10-year yield is holding up there at 4.04%. The market is basically saying, okay, maybe rates come down in the short term because the economy is slowing, but we are not comfortable lending money for 10 years at rock bottom rates yet because we just don't trust the long-term fiscal picture.
It's a signal of a regime shift.
Hmm.
The market is sensing that the old rules might be changing.
It's messy. And speaking of messy, let's talk about the single name movers. Because even in a totally flat market, stock selection was everything today. If
Yeah.
you picked the right ticker, you had a banner day. If you picked the wrong one,
You got crushed. This is the absolute hallmark of a chop session. When the index itself is flat, the dispersion, the difference between the winners and the losers, it just explodes. It becomes a true stock picker's market.
So let's start with the winners. Corsair, ticker CRSR, up 48.3%.
Almost 50% in a single day. That is just a massive, massive move.
And the catalyst was a Q4 double beat. They beat on both revenue and earnings, plus they announced a $50 million buyback.
This is a classic execution play, but it also tells us something really important about the consumer, I think. Corsair makes gaming hardware, peripherals. It's a consumer discretionary stock.
Right. And in a macro environment where we are all so worried about the consumer, where we just saw that inflation print drop because of potential demand destruction, for them to come out and beat on both the top and bottom lines is a huge signal.
It tells you that the whole consumer is dead narrative isn't evenly distributed. People might be cutting back on, say, groceries or travel, but they're clearly still buying high-end gaming gear.
We call it the GPU effect. It used to be the lipstick effect, the idea that in a recession, people would still buy small luxuries like lipstick to feel good. Now, in 2026, they buy mechanical keyboards and high-end headsets.
Entertainment becomes the priority when you can't afford to go on a big vacation.
And that buyback announcement is just the cherry on top. A $50 million buyback for a company of that size is a massive vote of confidence from management.
It's more than just confidence, it's a weapon. Corsair has had a notoriously high short interest for a while now. A lot of people were betting against it.
So when management comes out and says, hey, not only are we doing great, but we have cash and we're using it to buy our own stock right now, it triggers a massive squeeze.
All those shorts have to cover. They have to buy the stock to get out of their losing positions, which just drives the price up even further.
A 50% move like that shows you that the shorts were definitely completely caught offside. They were probably positioned for that weak consumer narrative, and Corsair just blew them right out of the water.
Then you have the other big winner today, Rivian, ticker RIVN, up 26.6%.
The headline was, Rivian stock recharged. I saw that everywhere.
This one is really significant because Rivian is so capital intensive. It's an EV maker. It needs a constant flow of cash just to survive and grow.
And in a high-rate environment, remember, the policy rate is still at 15.5%. Companies that burn cash, like Rivian does, usually get punished. They are the first to die when money gets expensive.
But Rivian rallied almost 30% today. So why? What happened?
It's because the absolute worst-case scenario was already priced in. The market had beaten Rivian's stock down so much, with everyone expecting bankruptcy or massive dilution or huge production failures,
That when the earnings report came in and it was just okay or better than feared,
the stock just exploded. It's a relief rally on steroids. It really emphasizes how much sentiment plays a role in these things.
so if everyone expects you to fail, just surviving and showing up looks like a major triumph.
It's the not dead yet trade. And in a choppy market like this, that trade can be incredibly powerful.
But then, for every winner, there's a loser. We have to talk about the cautionary tales. Because for every Corsair, there was an upstream bio, ticker UPB,
Oof, down 31.6%.
the classic biotech binary.
Yep. The reason was FDA and clinical concerns regarding their asthma drug. This is just a brutal reminder that the biotech sector does not care about your macro regime.
It doesn't care about GDP. It doesn't care about the inflation rate. It cares about the science and what the regulators think.
You can have the best macro tailwind in the entire world. You can have rates dropping to zero. But if the FDA has questions about your drug's competitive edge or its safety profile, your stock is going down 30%. It's just a binary outcome sector, period.
And then we had the mystery drops. We saw a company called Rich, ticker ANPA, down 50%. And another one, Mega, ticker MGRT, down 40%.
These are smaller cap names, and it's likely something idiosyncratic. We're still digging into the exact catalysts, but the real lesson for anyone listening here is the sheer volatility of the flush.
The flush. Explain that.
When small and mid-cap stocks break in this kind of nervous environment, there is often no bid. There's no one there to buy it. Because liquidity is so thin, remember, all the big players are focused on the macro picture. The market makers just pull their orders.
So the stock doesn't just drift down 5 or 10%.
No, it goes down 40, 50% in a straight line because there is literally no one there to catch the falling knife. It's a vacuum.
It's a very dangerous game if you're playing in those waters. You can wake up and half your position is just gone.
It is. And that leads us perfectly into looking at the plumbing, the warning lights under the dashboard. Because while the S&P index is flat, the actual mechanics of the market are flashing some serious yellow lights.
I want to pivot to what we call the plumbing, because while the stock market is sort of the flashy showroom where everyone looks at the shiny cars, the bond market is the mechanic under the lift, checking to see if the brake lines have been cut.
A great analogy. We already mentioned the VIX sitting at 21, but let's look at credit stress. This is the real canary in the coal mine. We're always watching HYG, that's the high-yield corporate bond ETF versus IEF, which is the 7 to 10-year Treasury ETF.
Right. We look at the performance difference between them. And today, high-yield underperformed treasuries by 0.3%.
Which, in plain English, means that investors were selling junk bonds and buying safe government bonds.
They were widening the spread. And when spreads widen, it means the market perceives a higher risk of corporate defaults. It's demanding more yield, more reward to hold risky corporate debt compared to safe government debt.
So here's the big disconnect. If GDP is at 1.3%, which is technically growth, and the economy is supposedly fine, why is the credit market so stressed? Why are the bond guys selling corporate debt?
That is the multi-billion-dollar question. And it's the single biggest divergence to watch heading into Tuesday. If the equity market is right, credit spreads should be tightening, not widening.
But if the credit market is right, then equities are mispriced for a slowdown. And historically, credit is usually smarter.
The credit guys are the ultimate pessimists who always read the fine print in the documents.
They are. And if they're selling junk bonds, it's because they're seeing cash flow problems on the horizon. They're seeing refinancing risks with rates where they are. They're worried that this inline GDP number is just masking some rotting wood underneath the floorboards.
They see that 15.5% interest rate starting to eat into corporate profits, and they are getting out before the defaults actually start to happen.
And the VIX premium just backs that story up. We call it vol premium high. The VIX itself is at 21, but the realized volatility, how much the market actually moved today, is much lower.
So traders are paying up for protection. It's like buying hurricane insurance when it's sunny outside. Insurance is very expensive right now.
Which usually happens right before a big break, right?
It does. It means the market is coiled up like a spring. Tension is building. So either we get a relief valve moment where the fear just dissipates and stocks rip higher, what we call a vol crush.
Or the risk that everyone is worried about actually gets realized.
Yeah.
Something breaks, and we trade down hard to finally catch up with all the fear that's been priced in.
It is not a comfortable place to be sitting. And then there's oil. Flat, just sitting at $62.69 a barrel.
Which is really notable for what it isn't doing.
It isn't participating in that reflation trade at all.
Right. If the yield curve is steepening and we think growth is okay, you'd expect oil to be bidding higher. But it's just stuck in the mud. It's an outlier. It might be signaling that the global demand picture, looking at China, looking at Europe, is actually much weaker than that U.S. GDP number would suggest.
Speaking of the global picture, we saw the euro take a pretty big hit today. The 6E futures were down 0.83% against the dollar. That's a big move for a major currency pair.
It's a massive move, and that plays right back into the U.S. equity picture. A stronger dollar, which is exactly what a weaker euro implies, is a headwind for U.S. multinational corporations.
So if the dollar rips higher because the U.S. economy is in this Goldilocks phase while Europe is struggling, that actually hurts the earnings for companies like Microsoft, Apple, Coca-Cola.
It's simple math. They get paid in euros, which are suddenly worth less, and then they have to report their earnings back in dollars.
So that's just another headwind that was probably keeping the S&P flat today. The currency markets are signaling U.S. dominance, but that dominance comes with a cost for the big exporters.
Okay, so let's tie this all together. We have a flat S&P 500, ripping crypto, nervous bond markets, expensive volatility, sleeping oil, and a rising dollar. That is the absolute definition of a chop session.
But we aren't done for the week yet, and this is the part that gets really interesting for anyone who's holding positions over this long weekend.
The unusual catalyst. Tonight, at 11 p.m. Eastern, the unemployment rate for January.
Hey, that's why.
I know, right? Who in their right mind schedules a major market-moving macro data point for 11 o'clock at night on a Friday before a holiday weekend?
It's just bizarre timing. But we have to deal with the tape we're given.
So 11 p.m. tonight. Liquidity in the futures market is going to be non-existent. The U.S. traders are at the bar or already in bed. Asia is just waking up. Europe is completely asleep.
This is peak danger hours for the market. When liquidity is this thin, even small orders can move the market significantly. If this unemployment number surprises, the way the inflation number missed this morning, the reaction could be violent.
So let's game it out. If the unemployment rate comes in much higher than expected,
Then the recession narrative immediately takes over. Bond yields would probably crash, the dollar would tank, and equity futures might gap down hard when they open on Sunday night.
and if it comes in much lower than expected,
Then the Goldilocks narrative fights back. But the real problem is the timing. You can't actively trade it. You can't adjust your stock portfolio at 11:05 p.m. on a Friday night.
you are completely locked into your positions until Tuesday morning. It's a helpless feeling. It's like being on a roller coaster that just stops while you're hanging upside down.
And that is exactly why we saw so much hedging today. That's why the VIX is at 21. No one wants to be caught naked short or naked long heading into an 11 p.m. print on a holiday weekend. It's just bad risk management.
Speaking of the holiday, Monday is President's Day. U.S. markets are closed, so the next time we can all really react to this new information is Tuesday morning. What are we going to be watching then?
We have to carry over the watch list from this morning. I'm looking right at IWM, the Russell 2000, the small caps. They were actually up 1.32% today,
A huge outperformance versus big tech.
significantly. So the question is, can they hold that bid?
Yeah.
Small caps are the most sensitive to the domestic economy and to interest rates. If that unemployment number tonight is bad, IWM is going to feel it the most on Tuesday. It is the highest beta play on the U.S. economy.
And what about QQQ, the NASDAQ?
Flat today. It needs to decide if it cares more about rates or about earnings. Right now, it's just paralyzed. It's waiting for a clear signal, and it didn't get one today.
And TLT, the long bond ETF. It was up about 0.5% today. That flight to safety trade is definitely simmering just below the surface.
You have to watch that carefully. If TLT starts ripping higher on Tuesday, which would mean yields are crashing, that is the definitive signal that the market is truly scared of a growth slowdown. That's the big risk-off signal.
So if we zoom out, what's the big picture frame for next week? How should people be thinking about this?
The carryover frame remains exactly what it was this morning. We're in a macro-driven, rate-sensitive regime. Do not fight the Fed, do not fight the rates narrative until you see volatility subside.
The technicals are secondary to the macro data right now.
Completely. Until that VIX drops back below, say, 18 or 17, you just have to respect the chop. Don't get overconfident.
And keep one eye on that 11 p.m. print tonight. It's the final card to be flipped for the week.
It's the joker in the deck.
So let's recap everything one last time. GDP held the line. Inflation missed massively to the downside. The big stock indexes chopped around and went nowhere, but crypto ripped higher.
The final card to flip is that 11 p.m. unemployment print tonight. It's the real wild card for the week.
That's your end of day wrap. We'll be back before the bell Tuesday. Morgan out.